Welcome to Cycles TV. This session of the Market Cycles Report is intended exclusively to provide information and education to help individuals better understand cycles and the markets. However, this information is not to be construed as professional advice as to the buying and selling of securities. In no event does the host express any opinion with respect to, or make recommendations regarding, the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading. Buying or selling decisions are solely within the personal discretion of each individual. And now, enjoy the show. Here is your host.
Welcome to the Foundation for the Study of Cycles. You are watching Cycles TV. We have Monday, same time, same place, for a session about cycle analysis and stock markets. That's what we're doing here. We use digital signal processing as our fundamental technology to try and discover cycles in financial markets. That's the purpose. And today I want to have another look at the stock markets. So let's do a basic cycle session today. Let's have a check at the S&P 500, the broader market. I will also use the equal weight S&P 500 versus the standard S&P 500 to see what's the difference between these two indices. Same basket of stocks. Let's see what cycles tell us. And then I will also have a look at Apple just at the end from the tech sector to see what's about this momentum we had in this area. Cycle analysis in the stock markets these days, since February, is a tough job. So it was not easy for cycles to guide us through the last 3 months. So it's even more important to have a review, isn't it? Yes. So let's get into. We are live. And as you know, we are live. It's time to bring up your questions. As always, in the chat section, I will monitor the chat. Latest at the end, we will take some time to review your question. Okay, so let's look at some major charts here. Let's start with what's that? Yeah, it's the S&P 500. Yeah, it's the S&P 500. So that's the current data we have from the stock markets. That's where we are in the S&P. Now we have 1 week downward movement. So let's see if this is the start of a new bull market, which is discussed, or if this is the end of just another upward leg and the start of another downward leg. So that's the question maybe cycles can answer. And at the bottom here, you see the current spectrum for this current price action in the S&P 500. First, if we have a closer look at that spectrum here at the bottom, you see a lot of peaks here in the lower range. So below 100 days, we see a lot of peaks, or around 100 days. There is some peaks, but then lots of peaks here. So it makes it quite complicated and not so easy to pick from these peaks in the spectrum. So, and from a theoretical point of view, these are valid peaks, so valid cycles we need to have a look at. And here, even in the larger or the higher length cycles, you can see them here. The amplitude is getting lower. So it looks like the shorter term cycles right now seem to be more important. But it would be nicer just to have 1 or 2 peaks here. So we have lots of peaks. So maybe that's also why it was hard during the period from February to June. What's the current dominant cycle? Really not able to pick the short-term active cycles here. And the one cycle which has been important for a long period in time was the cycle here where I'm hovering currently with around 170 days, 76 days now to say it specific. But it's interesting that this amplitude is more and more going down. So what you see during these times, these cycles seems to become more not so important these days as it maybe has been just in the past. So you see a shift in cycles when you historically analyze the spectrum from day to day. So, but that's That's what we have to deal with. That's the current status quo. I think there's nothing valid here in the longer range of daily cycles. We need to shift to a weekly view if we want to analyze that. So I would suggest 2 cycles to start with. So we have, the one at 95, or maybe let's make it maybe quite simple. You know that we have implemented some intelligence filtering, which is a mixture of having a look at the current shape of these cycles and different scientific measurements from all these peaks here in the spectrum. Therefore, let's just have a look at the right side of the list of these cycles here, where the highlighted ones have a number here at the right hand side, and these would be what we call artificial intelligence guided support. What are the dominant cycles looking at this spectrum here? This is if a machine would make a decision which cycles to pick. These are the 2 cycles which, from a machine learning point of view, would have been used as dominant cycles. So you see them here, they are labeled here. So the first or the second one is with a length of 95. And then the other next one is here with a length of 72. So these are 2 shorter term cycles, right? So let's just stick with what the machine would recommend to use. As I told you, it's anyhow hard to pick the cycles from this kind of spectrum. So if you have no clue, let's just go with the 2 cycles suggested from that point in time. So this is how the composite model looks like here at the top of that chart. I mean, looks quite good. By just picking 2 cycles, I think this is where the benefit to use this machine-guided selection of dominant cycles is. Just picking 2 cycles gives a very good clue about the rhythm of the market, at least for the last year. So for the last 12 months, just 2 cycles can explain the major rhythm of the market. That's why we want to use cycles. As said, I prefer to use the current past to do projections into the current future. If you should use more data if you want to get historical analysis and possible dominant cycles, which then might come us with these 170 something. Maybe let's talk about that in a second. So let's just give it a start with these 2 cycles here. I mean, that's the current outlook here using these 2 cycles. Let's make the picture even a little bit larger. That's what these 2 time cycles currently suggest here. So we have rolled over to the downswing of this cycle, which is then going into late summer, maybe into August this year. By the way, if you have followed the cycle analysis on the US equity markets, you know this was always the prediction where we expected another downward cycle to take place until the long-term cycle has been resolved. Unfortunately, we expected this peak to come in here in February, March, where this peak is located, but then this next upswing cycle has started. But at least now, just looking at these 2 cycles, looks like it has come to an end. We now can add different additional measurements here on this cycle, on this chart and this price data for the S&P 500. One is we could use the cyclic smooth RSI, which gives an indication from the price cycle where we are. It's just 1 click and we can activate this also onto the chart here down below. And what makes this indicator interesting, this is measuring now price and price extremes, and this indicator is automatically synced to the selected cycle, which has been used here at the top. So it's a synced price indicator using the length of the dominant cycle, which is much more in sync with the markets here. And the most interesting points in time are when the time cycle turns are in alignment with extremes of this indicator. So we can see this here in the past. So here's a time sync, which is in sync with the extreme in the upper band here. So here we also have a time sync. This is the time and this is the price sync. we have a down and this sync here. And there are also situations maybe when they are out of sync. So these are, right now, these are the situations when the time cycle and the price cycle is in sync. But here you see an example where we have no sync. Yeah? So this would suggest a low. Yeah? But if we move up, we don't have a low here on the cycle. Yeah? So this is invalid, where we don't get an combination of time and price cycles. So this is not valid. And even though this top here is also not valid, because we would expect a top crossing here. So these two signals would not have been valid. This time-based down cycle here could be seen as valid, as we have the same here, and this is good in terms of price movement. And then here we have the top here, which is good. And I mean, that's then the divergence here and here within top. So we have, and by the way, this low here, this is not in sync. Yeah, we have a low time-based cycle, but we have a missing low here. So that's, even though we had a low here, but this would not be a good signal. So what I wanted to highlight here, and it seems like, at least we needed to wait. So the this is not a valid low here. So, and then we had the signal starting price-based here in that area. Yeah, but you see during that area, we have not reached the possible top here, which now has been passed in this situation, which is in alignment with this situation here. So just to clean it up a little bit, that's now the link where we have this, this price-based cyclic pattern in sync with the time-based pattern, which at least from a cyclic perspective, just looking at the daily, would give us an indication we should expect now another downswing in the markets. And this was not valid. And now let's switch to the equal weight S&P, because I think that's more important, and at least could not explain everything. But let's switch now to the equal weight S&P 500. That's the data set now we have here. By the way, the first thing that pops up is that we have a divergence just between these indices. And I mean, it's the same basket of stocks, yeah? In both charts, we are looking at the S&P 500. One is just using the capital weights, and this is the equal weights, which takes out of the equation the momentum we had in just these 5 to 6 tech stocks, which drove the S&P 500 just above, just based on these small amount of stocks. And in the equal weight, the picture is quite different. So we have not made another top or higher top here in the markets, yeah, which we have in the S&P. So in this index here, and that's why I'm quite comfortable, we had the major top this year in the period of February. This is where we expected the main top to happen, by the way. Yeah, you remember this was the original point where we expected from a cyclic perspective the US equity markets to turn down again, which from an equal weight perspective did happen. Yeah, we are currently on track now. For sure, we made another up push here, but this is quite a lower high than that high here. So just looking at the equal weight, we are quite on track with having our main top in place since February, March. But let's have a look at the current situation. Yeah, we are not interested what has happened in the past, to be honest. So basic procedure. Let's have a look at the spectrum here down below. And here we have one larger cycle, which was not seen on the S&P 500, so it makes it interesting. We have quite a valid cycle, which shows up in the spectrum, 276 days. And this is interesting because that's not seen on the S&P 500. So let's use this cycle here. And we have a shorter one, which is 112 days here on the equal weight. So quite different cycles, having a look at the same basket of stocks. Yeah, makes it really interesting also that the cyclic perspective is changing here. And they are also marked as most dominant by our machine-guided selection of cycles. So this is the longer-term cycle here, which still confirms what I said, the expected top here taking place in February, March. This was, by the way, anyhow, we talked about back in February, March here. So this cycle seems to be still valid, at least looking at the equal weight, which has still room to go to the downside into September. Now let's add also the shorter term cycles, about 112, which is seen here. So now the shorter term cycle is also activated. By the way, which gives a quite perfect correlation here. So this is the major top, this is the secondary top we see here, which is quite lower. However, don't look at these time-based cycles for price projections. It's just interesting, but just the outlook now is the same. So that's why it's interesting that we have now a top here looking at the S&P 500 equal weight going now into September. And if you switch just to the S&P 500, we have passed a little bit the top here, but also into late July, at least for the next 4 weeks. And then we need to see how to adjust it. So different cycles, different cycle length, not the same cycles in regards to length, but same conclusion. And let's activate now also here the price-based cyclic alignment by activating the cyclic smoothed RSI indicator. Let's make the view a little bit larger. Let's switch to full screen here. Here's where we are. So here we have a clear, that's okay. We've touched the upper band here, which is a valid signal. So we touched the upper band and now going down, which is a valid, also price-based topping signal, exactly happening at the point in time when the time-based cycles indicate that. So, and the last time we had this alignment was here, aligned with this situation. And here you see the same behavior from a price-based analysis. This would have indicated a top here, but this happened at a time where we have not seen a downward time-based cycle push. So this little downward swing here, even it happened, was not an alignment between time and price-based cycles. The situation is quite different at that point in time here. So this was bottom from the price-based cycle extreme analysis happening, or at least confirmed at that point in time, time-wise. So here, price time-based cycles have come into alignment, which then lead to this upswing here. So that's how you could align it. Here we didn't have a perfect alignment, quite close, not perfect. Here we had it. So that's how you combine these price-based and time-based cyclic signals here. So at least that's the basic type or style of analysis if you would analyze the global stock markets right now. I think it still confirms the analysis we did here in February, March, where we indicated or where we forecasted that this is a major top, which is seen here by this cycle, and it's still valid looking at the equal weight. So now we've seen the upswing, which seems to have come to an end. Another upswing, we have not anticipated that this upswing, looking at these 5 stocks, will lead into another interim top in the S&P 500 at capital weighted, which is seen here. But as I said, it's a different picture if you look at even the broader market. So interesting to see if now this downswing cycle, which kicks in now, the second downswing cycle since February, this is now the second one, will bring markets down into late summer, which will then be in alignment with the longer term weekly cycle, which is still downward pointing. So that's it from the global main markets. I promised also to have a look at Apple. I like Apple as a proxy for the tech sector. So let's switch to Apple in that case. Here you see this enormous up run here, making another all-time high, even in Apple. I mean, I think if you look at Nvidia or whatever stock, looks quite similar. Not expected. Here we had this This was the February top. I mean, it's unbelievable. This was the February top here in the markets. You've seen where we have seen the major top also in the equal weight index, but it looks like the tech sector just ignored that and made this rally here. So therefore, let's have a look. I need to hide something, the harmonics. Let's have a look at the cycle spectrum here for that. And 2 cycles pop up. And there's a long-term cycle, which looks interesting here. And then the next one would be then here also indicated this 177-day cycle. That's, by the way, as said, it's becoming more and more not so important looking at the S&P. So let's just compare it here. Let's bring in the cycles here. This is the 170 something on the S&P, which compared to the smaller group of cycles has become less important. You see this cycle is still seen more important here on the Apple stock. So that's why it's always interesting that you have you know about what are the global major cycles, at least from the past, which are active, and at least in Apple it's still valid. So let's start with this one here. And yeah, just looking at the 170 something, which has not been used on the S&P. We just used shorter term cycles on the S&P, but using this on Apple, it's quite a nice rhythm for over the past year. Yeah, quite nice rhythm. I mean, just short term. Here also this cycle has come to an end now and has rolled over to the downswing, also showing a downswing into late summer, September this year. We could also add the longer term cycle into the mix, but as you see, even if you activate or deactivate this cycle, the general outlook does not change. Yeah, and that's why we do the time cycle analysis here. So doesn't matter if you put both in. Here is the top, just marking that, even if you put both cycles on or not, and even the low projection from a timing period is just here in that area. And it also don't matter if we just have both on or just one. Yeah. So the projection is downswing from here. And we had here the February top is not seen by these 2 cycles here. So, but interesting is the alignment of all 3 types of analysis. So we did the S&P 500, we did the S&P 500 equal weight, and now I added also the Apple stock chart, and all 3 show us the same conclusion for what the next cycle leg should be. And that's the story we, from a cycle analysis perspective, are interested in. Different assets, different weighted basket of assets, different cycle length, but all coming to the same conclusion. So that's the interesting part. Finally, let's activate also the price cycle analysis. And here, I mean, maybe we need to wait until this breaks down. So it looks like still momentum is on here, but we have now moved into an extreme situation here. So we need to wait until this up move and price is confirmed by a down move and then a break of this band here. So, which, yeah, I mean, you never know when the momentum, these kind of asset classes will come to an end, and maybe this is looks like a short-term momentum which has kicked in February. No one expected. Maybe this is not disrupting, but this is normally this would be noise. But if the noise level reaches such an enormous level so that it overrules every other cycles, so then the signal to noise ratio is just too low to identify the real cycles. I don't know if this is the case here. We need to monitor the tech in indices even better. But just to talk about cycle analysis now on the stock markets, that's cycles talk for this week. Global markets, US equities, different views, same story. So I think that's why I wanted to put this out. There is a clear conclusion looking at the cycle analysis. Let's see how it plays out. As always, we are never trading time-based cycles. You need to do your own analysis, looking at your price charts and derive your own decisions making on your analysis. This is just looking at time. Yeah, so I see some questions are coming in, so let's spend some time getting through all your comments. Yeah, thanks for mentioning some price data errors, which I will directly resolve after that session, which can always happen as we don't pull up new data every time, so we need to update once split half happens, and as this is not our data and we don't provide data, so we need to clean up if these errors happen over time. Thanks for mentioning these topics, Alan, and we will take care of it. I think, William, I want to talk about, you brought up the question, can you tell me about when and how long the advanced group will? Yeah, as if I'm aware of, we wanted to host the first session this week. So I need to talk to Bill. This week, Wednesday was planned, wasn't it? So 26, 27, 28. This week, Wednesday was planned, but I've also not seen the announcement. But William, it was planned this week, so I hope the announcement goes out. If not, then I think latest next week. Maybe there was a reason to skip it to next week. The duration is about 1 to 2 hours. So originally planned this week, Wednesday, but don't kill me on that. I need to get back to my colleagues in the FSC. Yeah, so maybe already this week, otherwise next week for 1 or 2 hours to take place. And after I think it's planned at the end of the US stock markets time-wise, so it depends about your time zone. But if you're in Europe, it should be later or late in the evening. If you are located in the US, it will be in the late afternoon. Okay. Thomas, the Slutsky effect. No, I'm not aware of that right now. So I need to research it on my own. So therefore, I cannot speak on that subject for today. But if you would like to bring in more details on that, feel free to drop me a note or put some comments below the video, or just send me an email, and I will look it up and check what's that about. And in relations to cycles, always interesting. So therefore, thanks for bringing up your questions. I just cannot comment right away. Yeah, maybe Michael, what is the in-sample and visible range correlation in the model builder? Just curious. Yeah, that's a fair question. Let me. Thomas, I see a question. I will put my email in the chat section in a second. So just hold on for a second. I just want to get back to Michael's question. What is the in-sample and visible range? Okay, so these two, I need to share the screen. So your question refers to these two numbers which are seen here. So in-sample correlation and visible range correlation. First of all, it's the correlation between the composite cycle, which based on the selected cycles here, between the composite cycle and the price. Yeah? And you see the first number is not changing, so it doesn't matter what I zoom in or zoom out, it will always have the same number as 0.73. And by the way, that's a positive, very, very good correlation. That's why it's shown in green, which means that the correlation between the composite cycle and the price is very high. So we have high correlation. And the in-sample correlation means it's related to the full data set you have selected for analysis. So from the start to the end, the correlation of the whole composite with the data currently within your analysis. That's why this number will not change regardless of what you do. The second number is just the correlation in the visible range. So what you see on the screen right now. So from left to right in the chart. So here you see this zoom in, of the price and the composite cycle. I mean, as you see visually, has a very high correlation of the visible range. And if you zoom out, now the correlation gets a little bit lower. And maybe we can also select a period where the correlation now gets even worse. You see just in this, not in sample, in the visible range, we have a not so good correlation. So the second value, you can zoom in and out different areas of the chart, which gives you a quick view on different correlation scores if you zoom in and out on different areas or ranges of the selection. That's why we have these two numbers. Anyhow, just be careful with these correlation scores. I personally don't pay too much attention, but it gives you some kinds of statistics about composite cycle, price data, correlation. Some like these kind of scores, so they are in. Michael, I hope this helps to answer your question. Thomas, how can I email you? I just wanted to get back to your question. Yeah, that's no secret. Give me a second. So how can I email you? Give me a second for the chat. I will not speak it out, but you should see it in the chat section, right? So, Thomas, feel free to use this email from the chat to drop me a note and an email. Okay. Yeah, I would propose that's it for today. Quick, simple, to the point for today. 30 minutes. You have the stock market, you have Apple, you have cycles, discussed some underlying fundamentals, just here with the application. That's it. So let's see how the week continues. And please, let's meet again next week, Monday, same time. If you're part of the advanced group, even this week or next week, we will have our first advanced session with this group also. Thanks for joining me today. Have a nice week. See you next week. Bye.